How would you feel if you bought this home in Oakville for $1.736 million in 2022, and then this year your neighbor sold an identical unit for $1.22 million, essentially wiping away $500,000 in equity on your home in about a year? Now you got some idiot on YouTube talking about it. Hey guys, Jordan from Precon here. Welcome back to the channel. If you're not subscribed, please go ahead and do so. It has been a while since I have gone through prices from peak, where we are today, and where prices are headed in the GTA in the near future. We're going to break it down by detached and condos. The reason I wanted to make this video is because when I've talked about home values in recent videos, I get a lot of comments from two camps. The first is the realtor camp, who love to pretend that this isn't a housing crash and prices haven't fallen, or they haven't fallen that much at all. And I think they're wrong. And then camp number two are the ultra bears, I like to call them, who say this is just the beginning. Things are going to get way worse than this from here. And I also don't agree with that take. I think the truth lies somewhere in the middle. So let's go ahead and kick this off with Toronto detached, because Toronto is the center of the Canadian universe and everything else orbits it. So at the absolute peak of our market, the average Toronto detached just shy of 2.1 million, now sitting at about 1.7. You can see when rates paused in the spring, we had a ton of positive sentiment in the market. We saw prices push up quite considerably, and then since then they have continued to slide. So you're looking at about a 17.2% correction for Toronto. So 416, Toronto includes everything from Etobicoke to Scarborough. Toronto detached 17% down. Here's an example in Lawrence Park North. You've got this sale back in 2022 for 2.4 million. The same property just resold for $1,865,000. Shifting focus over to Oakville here. At the absolute peak, 2.5 million for your average detached in Oakville. Today, about 1.8 million, so 28%. Now, one thing I want to mention about average versus median is on a low volume month like October, you're going to see these numbers skew a little bit. So I would take this number here with a grain of salt. It's probably more like a 20 to 23% correction across the board for most areas around the GTA. But regardless, here's an example. You've got this home that sold in 2021 for 1.93 million, just resold for 1.7 million today. So this property is down about $230,000 versus the 2021 pricing. And this is what I mean when I say, it's interesting when realtors say this isn't a housing crash. I mean, I guess at the end of the day, everyone has a different definition in their head for what a crash or a correction is. But I would think, generally speaking, a 20% correction across most housing prices in the GTA would be considered a housing crash, at least by historical norms. Now we get to Brampton, the green line at the bottom of the chart. So at the absolute peak of our market, 1.65 million. Today, 1.15 million. So a 30% correction in Brampton. For an example, in Brampton, we've got this property just earlier this year in that spring market where things were looking pretty good for a short window of time. This property sold for 1.3 million and it just resold for 1.05. Mississauga detached peaked out just shy of a $2 million average price point. Today, just above that $1.5 million mark. So you're looking at 20%. Like I said, 20% about average across the board. Now, some people will say this isn't a crash, this isn't a correction because of how frothy the market was when you look at peak pricing. A lot of the times people will say, when it comes to financial markets, we take the escalator up or the stairs up, you take the elevator down, meaning corrections are quick, whereas appreciation is sort of slow and more tempered. I would say in the case of sort of the peak insanity of our rate cut and COVID environment market, I would say it looks like we kind of took the rocket both up and down. I mean, you can see here on these charts that prices ripped 20, 25% in about a year, and then they corrected 20, 25% in about a year as well. So for Vaughan, 2.25 million on average, sitting at about 1.72 million today. So a 22.5% correction in prices in Vaughan. Now, of course, if you look at 5-year fixed rates at the absolute lowest level they've been at during our market, sort of around here, you'll find that, of course, carrying the mortgage with 20% down, 80% loan to value at peak prices is more affordable than today, which is why I think some people are surprised that prices haven't corrected more than this yet. Now, whenever you're looking at a market correction, I think it's always helpful to zoom out and look at sort of the long-term time horizon. So if you look at 1996 through today, you're including 2008, you're including the 2017 correction in detached prices, and of course, you're including today's correction in detached prices. We are still over that period of just over 25 years, averaging 7.1% compounding annually. Now, what's interesting is if you add a 6% trend line, you'll notice that housing prices in Toronto sort of hugged that line until 2013, 2014, where it really started to deviate from a 6% trend. Now, obviously 6% is still incredibly high for a housing market, but generally speaking, we hugged that line for a long period of time, and then we sort of deviated from it. So what happened in that area, 2013 through 2015? Well, housing starts didn't fall or didn't increase. They kind of stayed constant with our long-term average. They increased marginally, but mortgage rates did fall through that era. So you can see 2013, 2014 here, mortgage rates continued to fall. This wasn't anomalous to Canada. Obviously, it's a similar situation in the States. And of course, population growth. So around 2014, 2015, population growth started to rapidly increase. It tapered off during COVID, obviously, and now our new immigration targets are much, much higher than they were pre-COVID. Now, obviously, this correction in prices is predicated upon interest rates and affordability. Now, since the last video where I showed the implied short-term rate movements in Canada, the chart has changed. Obviously, the market is now pricing in rate cuts coming sooner rather than later. So if you look at for next year, the probability of certain rate cuts, this is cumulative, by the way. So if you look at this chart, it means that the market is essentially pricing in an 84% probability of 125 basis points or 1.25%. In cuts and rate cuts by the end of next year. Is that going to save us? Probably not. So do I think this is the bottom yet? No, I don't really think so. I mean, at the end of the day, I can't predict the future, but on one hand, you have the average borrower in Canada still at a sub 3% mortgage rate. Of course, as people start to renew at higher payments, the average payment is going up 25 to 40%, depending on where their fixed rate was previously. That stress makes its way through the market. On the other hand, 48% of Toronto homeowners without any mortgage on their property at all, and so they're not feeling any increased stress in terms of a mortgage. And we continue to see this rapid growth in population sort of paired with this mediocre growth in housing starts that if you look at the last 3 months in Canada, housing starts are actually starting to fall. And that's why I think that the market low that we eventually stall out at is probably going to disappoint the bears just as much as it upsets the housing bulls. And that's why I think the truth, again, lies somewhere in the middle. Now let's shift focus to condos. So we picked Toronto, Mississauga, and Vaughan because there's enough sales volume there for the condo segment on a monthly basis to get sort of an accurate picture of what's going on. So we'll focus in on condos in Toronto first. And again, Toronto, everything from Etobicoke to Scarborough, $822,000 at the peak, now at $729,000. So prices are down about 11% for Toronto condos. Mississauga condos, similar, about $100,000 down, but from a lower cost basis. So on a percentage wise, more. So $735,000 to $626,000. So just shy of 15% correction in Mississauga. And then we have Vaughan here. So Vaughan condos actually performed really well. They almost got to the same price as a Toronto condo. So $795,000 at the peak, $681,000 today. So 14% down. So you'll notice that Toronto condos are holding a little bit better than 905 sort of suburbs condos. And I wanted to illustrate this further, so I grabbed a couple of good buildings in the 905s and a couple of good buildings in Toronto proper, in downtown Toronto actually, to show you the difference in per square foot selling values last year versus this year. So let's take a look here. 300 Front Street down 1.9%. So, prices virtually unchanged from last year, despite the fact that, of course, affordability is way worse as a result of rates. 70 Distillery down 7%, 1 Yorkville down 6%, and 55 Bremner down 4.5%. Again, this is on per square foot selling values, not on average price, because there's just not enough volume in any given building to take average price at face value. And then we look at the 905s. You have a new build in Pickering that's down 14.3% year over year. You have one in Vaughan down 8.4%, and then two in Hamilton here down 9% and 12% respectively. So just again showing that the downtown Toronto condo pocket, despite the fact that months of inventory is north of 5, they're firmly in buyer's market territory. If you're in a good building, particularly a good unit in a good building, they're holding up a little bit better than the suburb condos, at least for the time being. So that's all I have for this video, guys. I hope this video was useful. Please like and subscribe, and I'll see you guys next video.